In the last video, we smashed through the 7 steps of the wealth ladder. I told you to fill your ISA with stocks, and I mentioned bonds as a safety net. But knowing where to put the money is only half the battle. You need to know what you are actually buying. Right. Let's be honest. When most people hear stocks and bonds, they think of men in pinstripe suits screaming into telephones, or the Wolf of Wall Street throwing dwarves at a dartboard. It feels like a casino. It feels like gambling. But if you want to be rich, and I mean properly, retire early rich, you need to understand these two things. And the good news? It is actually dead simple. It's not rocket science, it's just jargon. So today, I'm going to explain exactly what a stock is, what a bond is, and why you probably need both. Grab a brew, let's get it sorted. First up, stocks. You might hear them called shares or equities. It's all the same thing. Imagine this pub is a company. It's worth £100,000. If I buy a stock, I am literally buying a brick in the wall. I am a part owner. If the pub sells 1 million pints this year, the value of the pub goes up. My brick is now worth more. That is capital growth. Plus, if the landlord is feeling generous, he might share the profits with me and hand me a tenner at the end of the year. That is a dividend. Buying a stock is betting that the company will grow. But here is the catch. If the pub burns down, I lose my money. If nobody drinks beer anymore, I lose my money. Being an owner is risky. The value of your slice can go up, but it can also crash through the floor. That is why stocks are the engine of your wealth. They go fast, but they can be a bumpy ride. Historically, they return about 7% to 10% a year, but you have to have the stomach for the drops. So, what about bonds? In the UK, we often call government bonds gilts. A bond is totally different. You aren't an owner. You are the bank. You are lending money to the company or the government. You say, here is £100. Pay me back in 10 years. In return, they promise to pay you a little bit of interest, called a coupon, every single year until they pay you back. It is an I.O.U. It is boring. It is predictable. Why would you buy a bond if the returns are lower? Because they are safe. If the stock market crashes, companies might stop paying dividends. But a bond? They have to pay you. It's a contract. If you lend money to the UK government, a gilt, the only way you don't get paid is if the entire country goes bankrupt. And if that happens, we have bigger problems than your portfolio. Bonds are the brakes on your car. They stop you from crashing when the road gets icy. Here is the magic. Stocks and bonds usually, not always, but usually, work like a seesaw. When the economy is booming, stocks fly high, and bonds are boring. When the economy crashes and everyone panics, stocks tank, but everyone rushes to buy safe bonds, so bonds go up. By owning both, you smooth out the ride. You don't get the extreme highs, but you avoid the total wipeouts. So, how much of each do you need? This is called asset allocation. If you are young, say under 30, you have decades to ride out the bumps. You might go 100% stocks. You want pure growth. You don't need the brakes yet. But if you are 55 and retiring soon, you can't afford a crash. So you mix in some bonds. Maybe 60% stocks, 40% bonds. You are trading some growth for a good night's sleep. Now, do not go out and try to buy a single Apple bond or a Tesla stock. That is hard work. The beauty of the modern world is that you can buy a global index fund that does this for you. You can buy a life strategy fund or a target retirement fund where a computer decides the mix for you. You just click buy and you own 5,000 companies and 10,000 bonds instantly. One quick technical warning. Bond prices hate high interest rates. When interest rates go up, like they did recently, the value of old bonds goes down. It's a bit weird, but just remember, bonds are safer than stocks, but they aren't cash. They can still wobble. But over 20 years, they are the ballast in your ship. So there you have it. Stocks are for eating well. Bonds are for sleeping well. You probably need a bit of both. Don't let the jargon scare you off. The only people who want you to think this is complicated are the people charging you 2% fees to manage it for you. Ignore them. Buy the market. Hold it forever. Right. Hopefully that made sense. If you want more honest money tips without the waffle, do me a massive favor. Hit the like button and make sure you subscribe to the channel. Let's get your money sorted. See you in the next one. Cheers.